What is PE ratio? How to interpret the exact meaning of PE ratio? A lot of investors, when they get started into the journey, they are always told by some advisors that high PE matlab बहुत expensive hai, you should not buy a high PE stock. Low PE stock is actually very cheap, you should buy low PE stock. But that is far, far away from the truth, and that is where you need practical insights in terms of understanding what is PE ratio, how to get right kind of investment while understanding this valuation metric, and what does even high PE ratio, low PE ratio mean in different kind of business models. So in this video, we are going to go really deep dive. For next 30 minutes, we will dissect this entire topic with a lot of case studies, with a lot of examples, real world examples which we have applied in our journey and got benefited from it. You will be learning it too. So let's deep dive and let's dissect everything you need to know about PE ratio in investing. Awesome. Hi, I'm Vivek Mashrani and I'm a TechnoFunda Investing specialist. I've been into markets for more than 15 years and we have been working towards helping people compound better in terms of their money and lot more beyond. And I'll be teaching you in today's video a very special topic which many times it is misunderstood, is a topic of valuation, topic of interpreting price to earnings multiple. Okay, so let's straight away deep dive into this, and I'll share with you this entire presentation also towards this session itself, during this session itself. Before we move forward, this is a quick disclaimer, and some of the examples which I'll be sharing here, I might have recommended it to our clients or I might be personally holding it. So it's a quick disclaimer, and all these case studies which I'll be sharing with you are for illustration purpose only. Don't tomorrow buy and jump into those or sell it just because it is covered in this video. Okay, it's very case study specific what we have done it, and please remember that investment in security market are subject to market risks, and read all the documents carefully before investing. Now, while we are done with our disclosures and disclaimers, which are SEBI registered advisors interpretation, which you need to have, is the building blocks of returns. Like, what even forms the investing returns? If you want to maximize the returns, which all of you want to do, you want to compound better, first we need to understand what are even the building blocks of returns. And that is where there are these two things which you need to look. So first is the earnings growth. Like if you see, returns are nothing but what price you exited and what price you entered. So ratio between exit price and entry price. If I want to dissect this further, I can easily make it like earnings when I am exiting. So earnings per share when I'm exiting, divide by earnings per share when I'm entering it, and what was the valuation. So assuming, let's say I entered a stock at a price of 36 rupees. Okay, and that time the earnings of this company was 3 rupees, which means I paid the valuation of 12 times to the earnings per share of that company. Okay, when I'm exiting, the earnings of this company grew from 3 rupees to 6 rupees in this journey. It doubled. So part of the returns which I got from this stock was from the earnings growth, which is almost like 100% return. And part of the growth was due to expansion of the valuation, which means the price to earnings multiple, the price what investor was paying for every unit of earnings, that multiplied even further, that became 24x, and hence somebody was willing to pay me 144 rupees, which means my stock actually gave almost like a 300% return because of combination of both these things. Okay, so this is how the entire equation of price to earnings multiple work. Now let's go further and let's understand what is even PE. And there are two types of PE ratio generally we look at. The first thing is, what was the last year's earnings per share or last 12 months earnings per share, also called as TTM earnings. Okay, trailing 12 months earnings. So say for example, a company made earnings of 103.43 rupees and the price currently where it is trading is at 2840. So if we do 2840 divide by this number, we get a multiple which is called trailing 12 months PE ratio, okay, which is 27.4 times. Now that gives you an understanding of the past of the company, how the earnings was there in the past, but it doesn't give us an understanding of future multiple, and that is being interpreted by something called as forward earnings multiple, forward 12 months. And how to get forward earnings, because it is uncertain, right? So we use estimates to understand forward 12 months, and then we have price divided by forward multiple. That is called forward 12 months PE ratio. Now, there are two things which can give you some crazy returns. One, of course, it can be earnings growth. So one of the major driver for your investing returns is how the company is growing its earnings. And second is how fast the multiple or the valuation of the company is increased. Now, when a company's P ratio or any kind of valuation is increasing, it is called PE re-rating, or if it is any other multiple, it is called re-rating of that multiple, which means now in the minds of markets, now the perception about that company has changed. It could be due to several reasons, and let's understand what are these reasons. So, a perception of the company can change, and hence the valuation can get re-rated or P multiple can get re-rated due to various factors. Okay. First, it could be because of improving returns ratio. I cover this in detail, like we have an entire module of ratio analysis. When you are part of our community, you will see that. And there is a deeper metric like a returns on capital employed, ROE. If the multiple of these ratios are increasing, the P also tend to increase. Beating earnings expectation. सोचा कुछ था और हो कुछ गया, right? So earnings was not that great earlier. People thought it will not grow so much, but then suddenly it gives a positive surprise in the market. That also increases the valuation and it leads to re-rating. Sustained growth over time. See, market loves certainty. If you have stock which can continuously grow with a good certainty, a lot of people who are conservative investor, people who want to invest for a long time, they love those kind of stock and they are willing to pay slightly higher premium for buying those kind of stocks. So if you have more certainty about a company, you also get this benefit out here. Then it can be because of improved margin. It could be because industry there is some kind of tailwind. Say, hey, all steel companies there is a big order book. Like recently there is a water industry, right? Water theme, wastewater theme, where because of the government budget which is there, there is huge order book that is coming through. I've covered that entire video. It's called water waste theme stocks and sector analysis. So you can check out my YouTube channel and you can just check with this topic. You will get a full video. Another example is the capital markets theme. Like steadily the number of demat accounts and people participating in financial assets have grown multifold. And recently I also did a video on that, which is called mutual fund related stocks. Even the SIP people are doing regularly. So you can even check out that video. I've placed the link also below this in the description. You can check that out. It's a crazy analysis and you'll get a lot of ideas to work upon when you go through that video. But basically, when you have that kind of industry tailwinds, you get to grow very fast and that reflects in your re-rating multiple also. Then regulatory environment, increased confidence, right, in the investor's mind, whether it is due to bull market or whether it is due to more transparency or whether it is due to some management guidance, that also increases. And industry leadership, if a company is like really achieving a dominance inside that industry, like how Zomato and Swiggy has really got a dominance in terms of food delivery, market tends to give higher multiple and the stock gets re-rated. So this is what is something what you need to do. Now, how to make money in the market? As I mentioned, there are only two ways you can make money in the market. One, you need to have the earnings growth in your favor. and second, you need to have PE expansion. So for sustainable requires, you need balancing of both. You need a earnings growth also, and you need on the other hand the PE expansion also. You cannot just rely on one. If you rely on one, there is a lesser probability of success. You can still make money, but then there is a lesser success. So your best case scenario in terms of this happening, like just extension of that building block, best case scenario is when you have earnings growth, when you have longevity, it goes on for a long time, and then you have PE re-rating also. Imagine you bought an excellent company during a bear market, and then from bear market you are getting into bull market and you make crazy returns. The company grows crazy in terms of its earning, and it has a long runway through which it can keep compounding. Again, we have a deep module which we have built inside our community. It's called Core Portfolio Blueprint, where I cover all these factors in a very detailed way, and it helps you to analyze how to find such companies which has excellent earnings growth with longevity, and where potentially there is a PE re-rating that can also happen. Then there are other scenarios where one of the things are faltering. I'll not take much time here. Probably what I'll do is I'll share this presentation with all of you, so you can download this presentation. The link is also in the description, and go through these slides, because I don't want to rush through for the sake of it. It will need some time to absorb. So please make sure you go to this link, technofunda.co/PE ratio, and the entire presentation in the PDF I'll be sharing with all of you, so that you can refer it whenever you want, however you want, as many number of times as you want. This is like my way of giving back to the investing community. Okay, so let's go further. Let's go around the worst scenario where you have all the three firing against you, right? So you have earnings growth which is faltering, you have longevity which is faltering, where you have disruption, and company growth is also faltering. What I'll do is I'll take my video towards left side. So now you should be able to see this. So all these scenarios can really impact your investing returns, and these are not a great place to be in unless there is no other choice. Okay, so this is what you need to follow. But ultimately, I cover this topic of stage analysis inside our hackathon also, is that you need both the things, like how in Sholay movie we had Amitabh and both of these guys, Dharmendra and Amitabh, riding together. So we need earnings growth, and we need our Amitabh in form of PE re-rating also. So stage 2 is where you need to focus on when you are investing. So now we will understand more deeper that if this PE ratio is so simple, Vivek, you said it's so simple, price divided by earnings, and we got trailing 12 months and future 12 months, all those things are fine. तो फिर problem क्या है? Why is it so difficult? Why people are not able to make money? Why it is so much difficult to interpret? And this is where the problem lies. It's like that story of these 6 men and the elephant. Okay, so each investor is actually looking at the different things and interpreting different things for PE ratio, and hence a lot of people get confused. Okay, so let's understand what is the interpretation of the first blind man. Okay, so he says high PE indicates future growth potential, which is true, right? Sometimes when future earnings are going to be very high, in today's time, the market, if you look at trailing 12 months multiple, it will be very low. But market is a forward looking machine. It knows that, hey, in 2-3 years, it can go like crazy. Imagine some startup like a drone startup, or some company which is just emerging to grow. You might feel, hey, looking at the past, it is very bad. But if you look at future, the kind of orders they might be getting, even the video which I was talking about, water waste recycling, you will see that scenario, that companies in that sector, past they might not be having that kind of order book, but in future, they might have got a crazy order book. Even the videos which I did in 2022 in defense and railways, you can still check it out. That time when people look back, there was nothing. But fast forward 2-3 years, the kind of earnings and the order book and everything got traction was like crazy. So when you are looking at that point, you might be feeling, hey, the PE ratio is very high, but it indicates future growth potential. Let's understand second interpretation, which is second blind man, who is looking at low P ratio, and he says that low P suggests undervaluation. Many times it is true when the company is really small, when it is a bear market, when people are not aware about the trigger that time, or there are a lot of sector headwinds that has just passed, and now the earnings are at its bottom, probably that also indicates undervaluation. The third interpretation is P ratio are most meaningful when compared to peers. Sometimes just because it is very industry specific, you might need to compare it with the industry peers, because otherwise you might be comparing apple with oranges. You might be comparing a steel company with a FMCG company, or you might be comparing a real estate company with some kind of banking company, and that is where there is a huge mismatch. So if you want to interpret whether it is really cheap or not so cheap or expensive, you need to compare it with right peers. Many times when you compare with wrong peers, you get a wrong interpretation also. Okay, let's go with the fourth interpretation, sector or industry context ratio. This again I've covered, but each industry has its own dynamics, and you cannot again compare everything blanketly. Fifth interpretation is relative valuation belief, that P ratio are most meaningful when compared to peers. So many times one peer in that industry might be totally different and different kind of animal than all other companies in that sector. And at that point of time, you cannot again put a thumb rule that, hey, because all other peers are trading at 20 multiples, even this company should trade at a 20 multiple. It could happen that that company is a leader in that sector, that company is a monopoly in that sector, that company has some crazy competitive advantages. And if you want to know about such companies and how to think about it, I've done a video on monopoly, how companies create monopolies. And there is one more video which I've covered which talks about competitive advantages, that how companies can create competitive advantages and fetch higher multiple than their peers, because they are doing really something special. So both these videos are available. You should definitely check it out. I've placed their links also in the description. Okay, just go and check it out. Or just search with monopoly stocks Vivek Mashrani. Okay, competitive advantage Vivek Mashrani in YouTube, and you will find it. So hope you are finding it useful so far. If you are really loving it, just hit a thumbs up so that I know that you are loving it. And hope you have subscribed to this video and this channel, because a lot of such crazy stuff which we keep discussing, it is more like my online school where I keep teaching whatever topic I love and whatever are crazy nearer to my heart. Okay, so let's go deeper. Okay, I'll just remove this. And by the way, there is a powerful Excel also if you want to do some deep dive analysis of companies. I've created a powerful Excel template which can help you to screen right kind of companies. So you can go to this link, which is technofunda.co/excel. The link again is in the description, in the comment section, everywhere. You can go and download this powerful tool. This is going to again help you in your stock analysis. Okay, so let's go deeper. Let's understand contextually how to understand high PE and low PE and all those things. So the myth is that when it is low PE, my valuation is very cheap and I should be buying it. But many times, the future earnings potential might not be that great. The market itself might be in a bearish zone, and for many years there could be bear market that could keep on happening. Many times the sector itself is getting so many challenges and headwinds and some regulatory issues and all that thing. And that time market is actually discounting future depressing earnings, which right now is not visible. Okay, that time buying a low PE stock might not be a good idea to go for it. Many times people say, hey, if it is high PE, it is expensive in terms of valuation. Now, as a thumb rule, it is fine, but many times high PE might also be reflecting of improved sentiment in the market, the upcoming bull market in the whole market cycle. It could also be signifying a sunrise sector, like we have renewable energy, or we have EV, we have sectors like AI which is coming up. And by the way, I've done a lot of videos around this also, so you can check it out, like green energy, Vivek Mashrani, you will find my video. EV stocks in India, Vivek Mashrani, you will find that video, and I'll also share it here so that you can check it out. But you will get an idea that some of these emerging companies, because they are like startups and they are just brand new, there is long runway for the sector, they are just getting started. The valuation optically, the price to earnings multiple might optically look high, but actually it is not the case, because in future there will be earnings potential. Okay, and that is the third point, that there might be order book, there might be earnings visibility, there will be expansion plan. Check out my wastewater theme video. There is an entire slide where I've mentioned the kind of order book this entire sector is going to get, and probably for many years, there is a lot of future earnings potential that is coming your way. So that is how you can understand this. Now another trap is, in cyclical stocks. Okay, so these are like different kind of traps you need to avoid. So cyclical stocks at peak of its earning, because it goes undergoes the cycles, and I'll give you some examples also after this. You might think it is a low PE stock, but actually it is at peak of earnings. So it is discounting that earnings, and probably after that it might fall. There could be some one-off gains and earnings are inflated, and you might feel that PE ratio is actually low, but that is not a sustainable earnings for a long period of time. There could be business which is into structural decline, which is undergoing disruption. Okay, imagine a DVD company in cloud era. Okay, imagine companies like Kodak when cameras are going off. So business will be facing a structural decline, and market is smart. It knows that it's actually going through that disruption, and that is the reason it is estimating the future declined earnings and giving the multiple right now rather than based on its past earnings, and hence the valuation will be down and you might feel it is cheap, but it is actually a trap. And sometimes the company is not at all growing, it is stagnant. GDP is growing but the company is not growing. That time also you might get it at a cheaper rate. And the opposite is for high P ratio. Sometimes there is a boom in the cyclicals and you might end up buying at a high P ratio. Sometimes there will be narratives, hypes, people take the idea too stretch too far, and sometimes people ignore the advancement and disruptions, and that is the time you need to avoid high PE stock also. There is sometimes bubble in the market, and that is also the time when you should avoid FOMO and not get into high PE ratios. So what we do inside our TechnoFunda, and how do we overcome these challenges? So let's go about it. If you are all excited, just give me a thumbs up. So let me know if you are excited to know some case studies, how we do at TechnoFunda research and how we have been doing it. And by the way, if you are not following me on Twitter, you can go to this link, @Mashrani Vivek. Let's connect over Twitter as well. So kare to kya kare? Let's see what should we do as an investor. So what we do is we blend technicals and fundamentals, and we want to be in the sweet spot, Goldilocks spot, which is just right spot. And what we do for this is like this. So I'll give you a lot of examples. So we went into the research of a company called Trill, which is a very small company, and we saw that hey, there is a lot of dearth of transformers and the entire sector is picking up. This company had a large order book. In terms of past, there was not much of earnings, but the future visibility of earnings was very crazy. Like we could see that there are a lot of potential triggers that is coming up. There was huge tailwind, like because there was huge demand in the industry, there was huge tailwind. And the earnings were already depressed because they did some capex, there was some interest outflow, there was some depreciation. All those costs actually made the earnings depressed. So when we saw this, it was somewhere like 480 PE because the earnings were its lowest, but market was discounting the future growth. And what happened is, as soon as the growth came in, the PE actually started normalizing. So from 480 PE, it started going down and it started normalizing. But we are very clear that, hey, this is not like what it looks like. Jo dikhta hai wo hai nahi. So what 480 PE and all that, it is not actually the case, because the earnings are deceptive. It is a past earnings and not reflection of what company can do in the future. So this is where we saw the entire chart and we saw how it was moving, and we had our research report. This is just again for example. Right now it is not a buy or sell recommendation. It is more of a illustration so that you can connect the dots. So what we did was in March 2024, towards the end when it was 396 rupees, we were convinced about its prospects, and we actually had a buy initiation. As we speak today, from almost that 396 rupees, it is almost 1100 rupees. So this is the power of understanding PE ratio in a right way, that hey, if it is due to the depressed earnings and optically the PE ratio is looking good, even at that kind of multiple, when it is looking like a 300, 400 multiple, there is no harm in buying because the future earnings will take care of it. The second example is of PE re-rating plus earnings growth. So we came across this company called PGEL. It is into electronic manufacturing. And we saw that when we entered, based on the growth, it was growing at like, 40-50% revenue growth. We saw that the PE multiple, although it is looking decent, like 35, 36 kind of multiple, but when we looked at the kind of growth with which it was growing, we understood that it is very relatively cheap in terms of valuation, because the earnings growth will take care of the future forward multiple. And this is where we entered inside this company. So it was before split, it was somewhere around 260 rupees, so 2600 rupees. So after split, it was somewhere around 255, 260 rupees. So I'll just share with you where exactly we were able to get in. So when we entered, it was here 245 rupees in May, and as I'm recording this video, it is already more than 3x. Now what worked for this company? See, again, returns are immaterial. It became 3x, it's great. But the lessons what we need to learn is this, that it went under P re-rating, so the entire multiple expanded. So you can see here, it is now 120 multiple, and the earnings like almost doubled in less than 1 year. So if there is a crazy earnings growth, the market will also increase its multiple, and there will be re-rating. If you can ride both, it's a crazy multi-bagger how you can ride it. The third example I want to give is of Marksans Pharma. So this is again similar to PGL, where the earnings multiple was very reasonable. Like pharma market, it was just consolidating and it came out of a brutal stage 4. And this was available at some 20 multiple, and it was having reasonable earnings growth. We found this reasonably valued, and even the growth was great. And this is where we picked up. So this was somewhere around 187 rupees, 188 rupees, and this is how it panned out. Okay, so yeah, by the way, this is whatever research I'm showing you is part of our research services. Again, this is not a recommendation. I just picked it up so that it's real. On that same date, we picked up that stock, so that you understand that all these things are practically, you can apply this in real life. It is not a theoretical gyan which I'm giving to you. It's pretty much practical learning which I'm trying to provide you, and hence I've given all these examples so that you can connect the dots and you can understand that really it is possible. It's not like in hindsight, you can do it real time as well. So this is where we picked up this one, Marksans Pharma, and it was somewhere around 185. It almost doubled in less than 6 months, because the earnings growth started coming in, and also we had the PE re-rating also happening. Now a lot of people ask me that how do you even identify when PE re-rating will happen? See, it is extremely difficult to know when the sentiment of the market will change. But one of the way we use it is through technicals. Okay, so we use breakouts and indicators and a lot of these techniques. I have some of these learnings covered in deep dive in one of my course inside my community, which is called Technical Analysis Blueprint, where I've covered all these breakouts, how the base formation happens, how the price volume action happens. And if you want to have an introductory session of this, I have a good news for all of you. There is a complimentary free masterclass which all of you can attend. Again, the link of this is there in the description also. You can attend this webinar. You can understand how sector trigger, earnings trigger, price volume action, technicals, everything plays a role when it comes to taking decisions around your investing. Okay, so you can check out this and you can understand this. So coming back to our other example, so I think we have one more example is of Kaplan Point. So again here this was available at a very decent valuation, around 21 times multiple. We were convinced about the compounding journey of this company. We bought this company somewhere around 1400, and this was the research note. This was last year, 1 year, exactly 1 year before. And just to give you a context, what happened to it is from 1400 rupees, because of the earnings growth and some bit of earnings multiple getting re-rated, it is right now around 2400 rupees. So it has almost like multiplied by 80% from the point it was. Okay, so that is how both these things do it. And this is something, if you want to read more on TechnoFunda and personal finance, there are two books which I've written, which is called You Can Compound and Action, both of them published by Penguin, and you can go through this. But hope you enjoyed this entire video. Hope you got some crazy ideas, and hope you will apply these ideas into your real investing journey so that you can compound better. So that's it from my end. Vivek Mashrani signing off. Keep compounding, keep progressing in all areas of your life. That's my best wishes to each one of you. We'll see you in the next video. And if you want to go deeper and learn about this entire topic, I've shared all the links in the description and on your screen also. So with that note, thank you so much. Take care. Jai Hind, and we'll see you in the next one.